Good afternoon, everybody. Thank you for joining us today as we kick off what we think is our 23rd year of our speaker series. I want to extend a warm welcome to all of you and a special welcome to our speaker, Christina Hammervold, who joins us from Loeb in Chicago. A couple housekeeping items I need to attend to. First, I want to thank our advisory committee who organizes and selects our speakers every year. And you can see their names on the screen when Tamara shares the screen here. Yeah, there it is. I just want to thank all of our advisors who are on this. Wouldn't happen without them. This started years and years ago with a few people on this list and has continued to grow. And it's just a tremendous group. And I really want to thank them for all the work that they do. I also want to acknowledge my colleagues that are here with us today. Dan Rothblatt, Natella Roisman, Heather Baroff, and our new CEO, Aaron Lerner, I think is on as well. Next, I want to thank all the professional advisors here today who make referrals to us, and also those of you that have your own donor advised fund here. One very special advisor I want to talk about is Amir Mohsenen, a wealth advisor at Truist. I'm so pleased to say that Amir has referred many clients to us in this past year with the opportunity to work with him and his clients on the donation of a complex asset. We worked with their many advisors, attorneys, accountants, private bankers, et cetera, as they went through the sale of a very large business. To tell you the full story, I'm going to ask you to watch this very short video clip of Amir. Tamara, can you play the video clip?
I have the pleasure of being the wealth advisor for 3 dentists who had formed a dental business with over 30 offices around the country, and I'd worked with them for a number of years in anticipation that at some point they will be selling their practice. It became increasingly apparent that for the next chapter of their lives, they would like to be more active in the philanthropic space, working with the Jewish Community Foundation to help create the liquidity in the right structure that would allow them to take tax-efficient dollars and put them to work to make the world a better place. It was a great partnership we enjoyed. The really interesting part about it was that one of the partners wasn't Jewish, and yet the Jewish Community Foundation was there for everyone. They combined a very caring attitude towards the individuals and their families, and a high degree of competence. And then couple that with great communication, very responsive, and in the form that works for the clients. And I think we've got a beautiful arrangement there. People think about charitable planning in the context of taxes and dollars. But what they miss is the heart and soul that comes with working with the Jewish Community Foundation. Being a trusted partner means that there is an alignment between what the foundation wants to do and what the families in the foundation and ultimately the advisor wants to do. And that's where you build trust, is when you're all working towards the same goal. It does add meaning to my own life to be part of this community.
Amir, I can't thank you enough for telling that story. It was a really wonderful opportunity for us to work with this group of individuals and their families, as you said. And we're one of the very few community foundations who will do this kind of work. We don't charge extra for it. So if you have clients that have complex assets that they want to think about donating, LLCs, real estate, privately held stock, please be in touch with us, and we'd be happy to talk you through what we can do and how we can help your clients. Earlier today, we sent you the CV and slides for our speaker, Christina Hammervold. She has a very impressive CV. I hope you take the time to read it. She works with some of the most established global families with their wealth planning. And I can't thank you enough, Christina, for taking the time to prepare and speak to this group today. She's asked that we hold our questions until the end. So please send me your questions via the chat function, and we'll get to them at the end of her presentation. So thank you all for being here, and take it away, Christina.
Thank you, Steve. And I'd like to thank the Jewish Community Foundation for having me. And I'm happy to speak with you all today about a topic that's grown near and dear to my heart, I guess you would say, and provide an update on upcoming beneficial ownership reporting rules.
Hello.
Just bear with me a second while I pull up my slides and start sharing. Okay, there we go. So before we launch into the details of the rules, I just want to give a bit of background as context for how these, the impetus for these rules. So the US, in comparison to its peer countries, is late to the game, so to speak. A lot of European countries, for example, already have beneficial ownership reporting rules in place. So the US was seen as sort of a weak link in the chain on combating illicit activities such as money laundering, terrorist financing, corruption, and tax fraud. So this was seen as plugging that gap that currently exists. Generally, entities that are subject to the reporting requirements, which are called reporting companies, are required to report their beneficial owners to FinCEN. They're also required to disclose any changes in beneficial ownership as they occur. So it's not a one-time reporting requirement, but rather a continuing obligation. And the target of this legislation is anonymous shell companies that are used to hold assets and conduct transactions. But in order to do so, to target these companies, the government has cast a very wide net. So this FinCEN has estimated the amount of entities that will be reporting companies as at least 32.6 million in the first year, and then 5 million thereafter for the next decade. So it's cast a very wide net in order to catch these shell companies. And you can see in the rules a tension that FinCEN and Congress is struggling with, which is they don't want to impose large burdens on small businesses, and they're conscious of not doing so, but they also want to cast a wide net in order to be able to catch these bad actors who are using shell companies in a bad way. So that's throughout the legislation. And these rules will go in effect in a few months, starting on January 1, 2024. So we'll dig into the particulars of the rules, but before we do that, I just want to cut to the chase and give you all the key takeaways to keep in mind as we move through the presentation. So first, the requirements will apply to privately held LLCs, corporations, and other entities formed or registered to do business in any U.S. state or with any Native American tribe for any purpose. But most importantly, it's going to include entities that are established for private client structures for estate, investment, real estate, tax, privacy, or other personal planning purposes. Importantly, however, trusts used for estate planning purposes would generally not be considered reporting companies. So trusts themselves don't have reporting obligations. But that doesn't mean that information about trusts won't end up in the hands of FinCEN. So information about beneficial owners, including settlers and beneficiaries and trustees, can still be reported if the trust directly or indirectly owns a reporting company. And as far as the timeline, existing entities, so those are entities that are in existence before 2024, have a year to file. So they must file their initial reports by January 1st, 2025. And new entities, those are entities created or registered after January 1, 2024, they have 30 days within creation or registration to file. That's a pretty quick timeline. The beneficial ownership information will be reported to FinCEN. Importantly, it will not be publicly available. It's supposed to be stored in a secure database maintained by FinCEN, and it will not be subject to FOIA requests. So a little bit of a roadmap of the issues we're going to be tackling today is first being who must file. Then we're going to go into who must be identified in the reports and what information must be provided for those individuals. We'll then talk about when must reports be filed, as well as who will have access to the information, and finally we'll wrap up with the penalties for non-compliance. So first, who must file? And the short answer to that is reporting companies. So direct filing obligations under the statute are imposed on reporting companies themselves. That means the company has to file, not the beneficial owners. The companies file and they disclose their beneficial owners. The CTA divides reporting companies into two buckets. The first are domestic reporting companies, and the second are foreign reporting companies. So domestic reporting companies include corporations, LLCs, and other similar entities created by the filing of a document with the Secretary of State or similar office. In foreign reporting companies are non-US entities that are registered to do business in the US by the filing of a document. In general, the CTA targets smaller, unregulated companies that may act as shell companies. So a common example of a reporting company would be a Delaware LLC that's wholly owned by a trust or an individual. That would generally be a reporting company unless it qualifies for an exemption. So again, the trigger for being a reporting company is that you're created or registered by filing a document with the Secretary of State or similar office. So that's going to include categorically all LLCs, unless exempt, all corporations, unless exempt, and it would also likely include limited liability partnerships, limited liability limited partnerships, certain business trusts, and most limited partnerships. Individual states are going to differ on whether certain other types of entities are created by filing. So you'll have to refer to state law. For example, general partnerships and sole proprietorships. They're generally not going to be reporting companies. A question that you may think of is, well, what if I have a sole proprietorship that has filed for a business license or a business permit? Does that make it a reporting company? FinCEN has answered that question and said that they don't think that that type of licensing or permitting would trigger a reporting company obligation. But again, you'd have to look to local law. FinCEN said they may consider offering additional guidance on this issue in the future. Similarly, for non-US entities, only an entity that is registered to do business in the US by filing a document falls within the definition of reporting company. And that whether a foreign entity is required to do business will be governed by state law. So entities that generally don't fall within the scope of the CTA are sole proprietorships, general partnerships, foreign entities that are not registered to do business, and most trusts for estate planning purposes. But there's two important caveats about trusts. One, as I said earlier, information about trust beneficial owners can still be reported to FinCEN if a trust directly or indirectly owns a reporting company. And second, this may change in the future. In the CTA, Congress is grappling with what to do with trusts. You get the sense that they don't know how to treat them. And the Act specifically requires that a report be submitted to Congress within 2 years about the wisdom of treating trusts and partnerships as reporting companies. So it may very well be temporary that trusts aren't covered by the CTA, but currently they're not, but that could change in the future depending on the contents of the report and of course the makeup of Congress at the time. So the CTA does provide exemptions or exclusions from the definition of reporting company. There are 23 separate categories, and the exemptions are generally available for highly regulated entities and other low-risk entities. So just stepping back, the thought about these exemptions are these are the types of companies that already are under regulatory supervision, already have some type of oversight, so there's less risk that they're going to be used as anonymous shell companies to commit bad acts. So a couple examples of exemptions are 501c nonprofits, charitable trusts, publicly traded companies, insurance companies, banks, There's also exemptions for large operating companies with a physical presence in the US. We'll get to that in a second. As well as certain entities that are owned or controlled by an exempt entity. FinCEN has authority to add other categories of exemptions, but thus far has chosen not to do so. And as you read the notice of rulemaking, FinCEN makes clear that they are narrowly construing the exemptions because their desire is to cast as wide a net as possible. So those practicing in the private client space, unfortunately, there are no blanket exceptions for trust companies or family offices or typical family investment vehicles. And like I said previously, most privately held entities used for estate planning, investment, real estate, tax, privacy, or other personal planning will be considered reporting companies and will have to disclose their beneficial owners. But there are a few exemptions that could apply to some private client structures based on the context and the specifics of the structure. So for example, a bank exemption that may apply to licensed trust companies, which could include professional trust companies, as well as regulated private trust companies. Pooled investment vehicles exemption may apply for third-party funds that client structures are invested in. It may also apply to pooled investment vehicles or LLCs or limited partnerships that have several family members or several trusts invested in, but that's going to be maybe less common because there are certain registration and disclosure requirements under the Investment Company Act in order to qualify for these exemption. Also relevant, there's an exemption for tax exempt companies, and there's an exemption for large operating companies. That includes, so large operating company means a company that has over 20 full-time US employees. They have filed a US tax return or information return for the previous year, reporting US source receipts over $5 million, and they have a physical presence in the US. So those are real operating businesses. Subsidiary exemption may also apply. It applies to any entity whose ownership interests are controlled or wholly owned directly or indirectly by certain types of exempt entities, including a bank, a tax exempt entity, or a large operating company. And one thing to consider with trust structures is whether compliance burdens can be reduced if a licensed trust company or a licensed PTC serves as trustees of a family's trust structure. It's possible to take the position that in that case, the companies underlying the trust may qualify for this exemption, but that's not entirely clear. There's some articles that discuss the strategy, but it relies on some gaps and some assumptions in the regulatory language that are less than clear. So we just answered the first question. Who must file these reports? And the answer is a reporting company. So now that we've decided that we have a reporting company, who must be identified in these reports that the reporting company is going to be filed? And there's two categories: applicants and beneficial owners. And importantly, on all of this, who's getting reported are individuals. So only individuals can be applicants, and only individuals can be beneficial owners. So that means if you have an LLC that is owned by a trust, you can't just stop at the trust. You have to look through the trust to figure out the beneficial owners. And we'll talk about how you do that. So just some limitations on reporting of applicants. So reporting companies that are formed or registered before 2024 will not have to report their applicants. So they'll only have to report their beneficial owners. And second, For reporting companies that do have to report their applicants, they only have to disclose their applicants typically in their initial filing. They're not required to file updates about their applicants. For example, if their applicant moves, they're not required to file an updated report. But you are required to correct any inaccuracies if there was a mistake in the initial filing with respect to an applicant. So first question, who is an applicant? So an applicant may be some of you on this Zoom. It includes people who are involved in the formation or registration of entities. So the term is going to include either one or two individuals. It will always include the individual who directly files the document that either creates the entity or first registers the entity to do business in the US. So for example, if you have a paralegal who files a document with the California Secretary of State to form an LLC, the paralegal will be an applicant and must be disclosed to FinCEN on the reporting company's report. The second category of individuals that may be reportable is the individual who is primarily responsible for directing or controlling the filing of the document, if more than one individual is involved in filing. So if only one person is involved in the filing of the document, it's just that one person that's reported. But if there's more than one, anyone who's directed or controlled will also be reportable. And so FinCEN gives a couple examples. And I'll read one, which is, I think, helpful. It says, there may be an attorney primarily responsible for overseeing the preparation and filing of incorporation documents and a paralegal who directly files them with a state office to create the reporting company. In this example, the reporting company would report two company applicants, the attorney and the paralegal, but additional individuals who may be indirectly involved in the filing would not need to be reported. And I think this is an interesting example because before, when I read the rules, I thought that the paralegal who directly filed the document would be reportable. But I thought there would be a position for saying that the person directing or controlling the filing would be the client themselves. But this example from FinCEN suggests that that wouldn't be the case, that instead the attorney directing the filing would be reportable as an applicant. FinCEN gives another example, which is more simplistic. It says an individual may prepare and self-file documents to create the individual's own reporting company. In this case, the reporting company would report one applicant. The individual would also be reported as the beneficial owner. Again, I think there's a lack of clarity as to who is the person responsible for overseeing the preparation and filing of the creation registration document, particularly, for example, if you have a client that has a family office or multiple attorneys involved in the creation. But we will see if there's future guidance on the subject to help illuminate and give further examples. FinCEN has promised to offer more Q&A and more guidance, but there's no timing for doing so. So now that we've gone through the first category, applicants, let's go through the second category. Who is a beneficial owner? And again, a beneficial owner is an individual. So if you have intermediary entities or intermediary trusts that own a reporting company, you have to look through them to find the beneficial owners. The individuals are warm bodies at the end of the chain. So the term beneficial owner is defined broadly to include any individual who directly or indirectly, through any contract, arrangement, understanding, relationship, or otherwise, either one, exercises substantial control, or two, owns or controls at least 25% of the ownership interests of the entities. So there's a substantial control test and there's an ownership test. And if an individual meets either one of those, they're reportable. And before we launch into what substantial control and ownership means for these purposes, It's worth noting that there are certain categories of individuals that are excluded from the definition of beneficial owner, including minors, but you have to provide information about a parent or guardian. Nominees, intermediaries, custodians, and agents acting on behalf of other individuals are also exempt, as well as individuals acting solely as employees, but only if they're not a senior officer of the company. So for example, a CEO who is an employee of a reporting company, even though he is an employee, he wouldn't qualify for this exclusion because he's also a senior officer. There's an exclusion for individuals whose only interest is a future interest through a right of inheritance, as well as creditors. So first we'll go into the substantial control test. The regulations help provide clarity on what substantial control means. And there are 4 different categories. So an individual exercises substantial control if they serve as a senior officer of the reporting company, if they have authority to appoint or remove a senior officer or a majority of the board of directors or similar body, if they direct, determine, or have substantial influence over important decisions made by the reporting company, or if they have any other form of substantial control, a catch-all at the end. And substantial control does not require ownership. It relates to authority and decision-making. And it can be exercised directly or indirectly, for example, as a trustee who's exercising control rights over shares that are held in a trust. It could be through board representation, through holding voting power or voting rights. It can be by controlling an intermediary entity within an ownership chain or nominee arrangements. It's very broad, and FinCEN has included the catch-all of any other form of substantial control because they want to capture as many people as possible, and they really are concerned with substance over form. So based on the breadth of the substantial control definition, FinCEN expects that a reporting company would identify at least one beneficial owner under the substantial control test. But you know, for some KYC purposes, you only need to name one beneficial owner. And once you have one, you can stop there. That's not the case with the CTA. You have to name each and every individual who meets the definition of substantial control. FinCEN is worried that if they only require one person to be named, that the rules, that a bad actor could go around the rules and name basically a nominee as a senior officer, disclose that person, and not disclose the person who's ultimately pulling the strings. That said, the definition is very broad and quite vague and circular, so it may be difficult to apply to multi-tier structures involving companies and trusts. You know, if you have a simple structure, an LLC that's wholly owned by an individual, and that individual is the sole manager of the LLC, and there's no other officers or employees of the LLC, it's quite simple. That individual is reportable because they have substantial control, also because they have ownership. But as you get into more complex structures and more complex control rights and documents, it may be hard to figure out who controls. Importantly, FinCEN does not believe that tax professionals or attorneys, while advising in their professional capacities, are in substantial control of reporting companies. So first test was the substantial control test, and the second test is an ownership test. So as an initial matter, ownership interests are defined very broadly. They can include equity interests, profits interests, capital interests, convertible interests, options, puts, calls, straddles. So it's a very inclusive definition. And basically, when in doubt, the final regulations seem to suggest that it's an ownership interest. Ownership interests can be owned or controlled directly or indirectly, including joint ownership, through another individual acting as a nominee, through a trust or similar arrangement. But there is some limit. There are no constructive ownership or attribution rules. So an individual is not attributed ownership of an interest held by his or her family member. So for example, I'm not attributed ownership of an interest that's held by my parent. And the final regulations provide specific guidance on how to calculate the ownership percentage owned by an individual. So one question that I get a lot when I talk about the CTA or I'm helping clients work through their obligations on the CTA is, how do you determine the beneficial owner of a reporting company held through a trust? And that's a great question, and the answer is not as clear as I would like it to be. So as an initial matter, the regulations provide 5 categories of individuals that are always reportable when an ownership interest is held by a trust. So in that scenario, a grantor or settlor who has the right to revoke the trust or otherwise withdraw the assets of the trust is reportable. So is a beneficiary who is the sole permissible recipient of income distribution of or withdraw substantially all the assets from the trust. The trustee is reportable, and so is someone who has the authority to dispose of trust assets. But this is not the full universe of people who are reportable. FinCEN makes that abundantly clear. These are merely examples, and other people may be reportable in the trust depending on the particular specifics of the trust arrangement. And also, multiple people can be reportable through the trust. So for example, if you have a trust with where a person other than the grantor serves as trustee, and the grantor has a right to revoke, and you have a beneficiary with a general power of appointment, in that case, the grantor, the beneficiary with the general power of appointment, and the trustee are all reportable with respect to that same percentage interest that's held in the trust. So a few questions to think about with respect to trusts and beneficial owners. Other rules, like I said, may be reportable depending on the specifics. That could include protectors, distribution advisors, or investment advisors. So you'll have to give that some thought based on the structure. And I get this next question all the time: which beneficiaries, if any, are reportable if a reporting company is owned by a wholly discretionary trust? It's a great question, one that I have as well. And the answer is, who knows? Some commentary states that the conservative approach would be to disclose all discretionary beneficiaries in that scenario. That is a conservative approach. Other commentary states that you can take the position that you don't have to report any beneficiaries. I think you're going to have to look at the specific facts and circumstances of the structure and make a decision weighing the risks and potential penalties. For example, if you have a fully discretionary trust set up by an individual, and that individual is the only individual that's been getting distributions from the trust, you may consider reporting that individual. Whether you report other beneficiaries as well is another issue. It's going to be context specific. Hopefully FinCEN will provide more guidance on this issue, but for now we don't have much to go off, unfortunately. Okay, so we've decided we have a reporting company. We have an LLC, for example, that doesn't qualify for an exemption. We have figured out who our applicants are. We have figured out who our beneficial owners are. What information do we need to provide? Well, you need to provide information about the reporting company itself, and you need to provide information about the individuals who are applicants and beneficial owners. So first, let's go with the reporting company. For the reporting company, you have to provide the full name, any trade or DBA name, the reporting company's current street address, and generally that's the principal place of business in the US. You cannot provide a PO box or address of a third party. They want to know where the business is. You also have to disclose the jurisdiction of formation. For a non-US reporting company, you also have to state the jurisdiction where the company first registers to do business in the US. And you have to provide an IRS taxpayer identification number or an EIN. Okay, for beneficial owners and applicants, you have to provide full legal name, the date of birth, current street address. And for an applicant who forms or registers a company in the course of his or her business, that's going to be the business street address. For everyone else, that's going to be their residential street address. And you cannot use a PO box, and you cannot use the address of a third party. For applicants and beneficial owners, you also have to provide an ID number from an acceptable document. Generally, that's going to be a passport or driver's license number. And you also have to provide an image of the ID document showing both the person's photo and the ID number. So you may be thinking, I form entities for my clients, and I may be an applicant, and I don't really feel comfortable providing a copy of my passport to my clients. Well, FinCEN has offered an alternative for that. So beneficial owners, applicants, and reporting companies can apply for a FinCEN identifier and provide that number in lieu of providing the full list of required information to a reporting company. So the process for doing that, the beneficial owner or applicant would submit an application to FinCEN where they provide all of the information that we just went over for themselves, copy of their passport, full name, address, and then FinCEN would give them back a number. And then when any reporting company asks for their information, they would provide their name to the reporting company as well as their FinCEN identifier number. And giving FinCEN identifiers would be beneficial for people in two camps. One is if an individual serves as a beneficial owner or applicant of multiple reporting companies. Because, for example, if that person moves, then the reporting company would have to update their report where in every report where that person is named as a beneficial owner or applicant. So that could affect a lot of reports. So it's more streamlined to have the individual take responsibility for that with their FinCEN identifier application. The second camp of people who may be interested in FinCEN identifiers are those who have privacy considerations and don't want to provide the information directly to a reporting company. One question that comes up as you wade through the rules is whether if a company has a FinCEN identifier, whether it's possible to provide that FinCEN identifier if that company is an intermediary entity. So for example, let's think about an LLC that's owned by a corporation, and that corporation is owned by individuals. Well, the corporation, let's say, has already filed its report with FinCEN, and it's disclosed the individual owners that it has. Well, the LLC has now been formed and needs to file to disclose its beneficial owners. Can it just give the FinCEN number for the corporation and stop there and not to have to duplicatively report the individuals who have already been reported for the corporation? And the answer is, it depends. Sometimes it can. There are very strict requirements on when you can do that. Most importantly, you can only do that if the individuals that are beneficial owners of the intermediate entity are beneficial owners of the reporting company and vice versa. So the beneficial owners of the LLC and corporation have to completely overlap. If there's any beneficial owner that's a beneficial owner of the corporation and not the LLC or vice versa, then you can't use this rule. It's purposefully narrow because FinCEN is concerned that the otherwise intermediary entities could give the number to obscure the identity of beneficial owners. Certification requirement. I won't really go into this much except for to say that there is a certification requirement. A reporting company has to certify that the reports are true, correct, and complete. There's no knowledge qualification or good faith qualification. But generally, FinCEN has said that it doesn't expect that an inadvertent mistake made by a reporting company acting in good faith after diligent inquiry would constitute a willfully false or fraudulent violation that would be subject to penalties. When must reports be filed? So deadlines. Different deadlines exist for new and existing entities. A new entity being an entity that's formed or registered on or after January 1, 2024. They have 30 days with information or registration to file. So it's a pretty quick turnaround. Existing entities, so those are reporting companies formed or registered before 2024, must file initial reports no later than January 1, 2025. So they have a year to file. But there's not just initial reports. Again, this is an ongoing obligation. So reporting companies are required to update information in a timely manner and correct any inaccurate information. So updates first. If there has been a change in beneficial ownership or a change with respect to information reported for the reporting company or any beneficial owner, for example, an address change. Beneficial owners all stay the same, but Susie, who's the beneficial owner, she moves. An updated report must be filed, and it must be filed within 30 days. Updated reports must also be filed if a reporting company was previously exempt but no longer meets exemption criteria. If it filed the initial report but meets exemption criteria, in that case, the updated report just says, I'm exempt now. Or if a minor that is a beneficial owner attains the age of majority, if information for a parent or guardian was previously provided. FinCEN has clarified that it does not expect that reporting companies would file when they are terminated or dissolved. Corrected reports similarly must be filed within 30 days, and that's 30 days of becoming aware or having reason to know of an inaccuracy in the earlier report. And individuals with a FinCEN identifier must make updates or corrections to their information by submitting a new application or an updated application rather to FinCEN. And it's subject to the same timelines. So that means 30 days within an update to their information, or 30 days upon discovery of an inaccuracy in a previous report they have to file. And the final regulations do not currently allow for companies to get an extension for the deadlines. But FinCEN is considering this and may provide guidance or relief in the future. So when will these rules take effect? Again, they come into effect on January 1, 2024. No reporting yet, but it's coming up soon. Who will have access to the information? Significantly, this information is not going to be publicly available, and it's not subject to a FOIA request. So someone can't submit a FOIA request to find out a beneficial owner of an entity. It's going to be secure. It's going to be stored in a secure private database maintained by FinCEN. And the Department of the Treasury has its own authorization to use the information, including for tax-related purposes. Information is also available in limited situations upon appropriate request by U.S. federal law enforcement agencies. That also includes U.S. law enforcement making requests on behalf of non-U.S. law enforcement. Certain federal agencies can get to the information, and also state and local law enforcement with court authorization. Also, financial institutions that have the consent of the company or entity can get to the information. And presumably that's to make sure that's part of the KYC process for financial institutions. In order to ensure that the information stays secure, the CTA imposes penalties for unauthorized disclosure or use of the information. FinCEN is going to issue new regulation or final regulations about who may access the information for what purposes and required safeguards. And they're supposed to do that by the time reporting becomes live. So by January 1, 2024. What are the penalties for non-compliance? So just the scope of penalties, what acts they can apply to. They can apply to failure to report, failure to update information, failure to correct inaccurate information, or providing or attempting to provide false or fraudulent beneficial ownership information. And so here's exactly what the final regulations state. It shall be unlawful for any person to willfully provide or attempt to provide false or fraudulent beneficial ownership, including a false or fraudulent identifying photograph or document to FinCEN in accordance with this section, or to willfully fail to report complete or updated beneficial ownership information to FinCEN. And in this context, willfully means the voluntary, intentional violation of a known legal duty. Civil penalties are $500 per day. Criminal penalties are $10,000 fine and or imprisonment for up to 2 years. So pretty real penalties. And I said earlier that reporting companies are on the hook. They're the ones who have the direct reporting obligations. But the scope of penalties is broader. It can also apply to individuals and other entities. So significantly in the case of individuals, penalties can apply to the extent he or she causes the failure, or if he or she is a senior officer of a reporting company when it willfully fails to report complete or updated beneficial ownership information. And just practically speaking, an entity that doesn't comply is likely going to find it hard to maintain or open a bank account. Some parting thoughts. So what are states likely to do? Well, New York is an interesting case. This summer, the New York legislature passed the LLC Transparency Act. It's not yet become law because it hasn't been signed by the governor. But if it does become law, it would require LLCs that are registered or formed or registered to do business in New York to disclose their beneficial owners by January 1, 2025. It's based on the CTA, but there's one very important difference. It would create a public registry. So everyone in New York would know, everyone would know who owned New York LLCs. It's possible that other states will follow New York's lead, but we'll have to wait and see what happens. One question I get asked a lot is, can we expect FinCEN to delay compliance? Is this actually going to happen on January 1? This seems like a lot. Again, I've anecdotally heard that FinCEN is ready to go, and the online reporting system is ready to collect information. That being said, about a month ago, FinCEN filed a proposed deadline extension entitled Beneficial Ownership Information Reporting Deadline Extension for reporting companies created or registered in 2024. The text is not included. We only have the title, and it's currently pending review, so we don't know if it's even going to get passed. But my thought, based on commentary that I've seen, is that the extension could apply, just as the title says, to companies created or registered in 2024, allowing them till 2025 to file. And the thought being that FinCEN and Congress are really concerned that they haven't sufficiently gotten the word out about these new reporting requirements. And new companies, for example, created in 2024 would only have 30 days to file to report their beneficial owners. And they're just worried that small businesses aren't geared up to do this yet because their advisors don't know, and certainly the clients don't know yet. And so I think the extension would allow companies created in 2024 until 2025 to file. But again, we don't have the text, and we don't know if it's going to be approved, but that's it, floating around. And some other considerations to think about, especially those who practice in this space, is whether should law firms and other service providers adopt policies limiting which of their personnel are involved in forming LLCs. For example, should paralegals or attorneys stop signing formation documents on behalf of clients? That's a firm or person-specific question to answer, but it's something to grapple with for sure. And how should service providers educate their clients about these new reporting requirements? I know my firm has issued client alerts. We've spoken with specific clients via email or phone about them, but it affects a lot of people. And so the question is how to cast that wide net and make sure, for example, that client alerts don't get caught up in spam filters, so clients are actually reading about this new rule. And finally, should service providers revise their engagement letters to disclaim responsibility for CTA filings, except as otherwise expressly agreed between the service provider and client? I've seen that question be raised. What's the potential scope of liability? I've talked a while, so now I'm going to stop and see if we have any questions.
Thank you, Christina. That was that was a lot of information to take in. I do have a few questions, and you may have touched on it, but people wrote them in here, so I want to make sure we get to them. Mm-hmm. What if one person holds multiple roles, trustee, beneficiary, grantor, et cetera, to report them once, all their roles, or report each role for that person separately? So maybe people in multiple categories. And for attorneys, you touched on this a little bit, could they be, if the formation person, as well as a beneficiary and limited partnership, they could be in another role? So what do they do about that?
Yeah, so first question first, if someone is a beneficial owner because they carry multiple hats, they serve as manager, they're also beneficiary of a trust or trustee of a trust, you only report them one time as beneficial owner. And as far as someone who serves both as an applicant and a beneficial owner, I believe they would only be reportable one time on the form. I'm saying I believe because FinCEN has issued a not so helpful form of what's going to be required, but it's hard to read because it's in the book of federal regulations, and it's not in it's going to be it's going to be an online reporting system, and we haven't seen the actual system itself, so it's hard to know how the prompts are going to look when we actually go. So I don't know the answer to that question, unfortunately.
What do you do when, or how do you report the applicant when a company, like a third party like CSC, files the documents to form an entity?
That's a great question. So it's going to be the actual person at CSC who sends it in. And that may be a question too for CSC. I don't know how their systems run. I know that those corporate service providers are working through the CTA and how they're going to go about this, but we're going to need assistance from them to know who to report. But it's going to be some individual at CSC.
Are family office employees who are delegated agents of an LLC or FLP required to be identified under the substantial control test?
So the question to that depends on whether I'm referring to my notes, if there's an exclusion for individuals that are sorry, I'm looking for individuals acting solely as employees. So they may fall within that exemption. It would depend on the particulars of the structure, but it's possible that they could fall within that bucket and not be reportable.
I think the last question we have is there any downside? Oh, no, there are more questions. Okay. Is there any downside for everyone getting a FinCEN identifier to make reporting easier?
No, I think it's actually a fabulous idea. I think that would make life easier.
Right. This is a pretty long question. I don't know if you can see the chat function, Christina, yeah. But if you can, you might want to take a look at this one yourself, the question, because it's pretty lengthy. Jeopardy music in the background for everybody while we're waiting.
Okay, so I'll go over I've read it, but I'm going to read it and then answer. So the first three-part question. First, does the beneficiary have to be reported if they are a sole beneficiary currently, but if they have children in the future, they no longer become the sole beneficiary? Maybe. So if they're the sole beneficiary and they have a right to revoke or withdraw all of the assets before they have the child, then they are reportable initially, at least. If they don't have the right to revoke or the right to withdraw all of the trust assets, then the answer is it depends whether they're reportable. There's no hard and fast rule. Probably in that scenario, I think they would be. But that's just based on a gut rather than an actual rule that says they specifically have to report. And then what happens when a child is born and there's multiple beneficiaries of the trust? I don't know. Maybe it's still the case that maybe you leave just the initial settler beneficiary as the reportable person. Maybe you update to add the new beneficiary. Again, it'll just depend on the facts and circumstances. It's hard to know how to report in that scenario, unfortunately. And for the second question, for foreign entities, is the only first requirement for there being a reporting company that they are registered to do business in the US? Yes. There aren't any other factors that would catch a foreign company that's not registered to do business in the US, such as the owner of the foreign company is a US citizen, or et cetera. Correct. So if you have, for example, a company established in the British Virgin Islands, and it is not registered to do business in any state in the US, but it owns interest in a US company or in US real estate, not reportable. It's owned by a US person, not reportable. The only trigger is that it's registered to do business in a state. That completely determines whether the foreign company has an obligation to report. And finally, for the large company exception, does it not apply to disregarded entities, even if they are a large company otherwise? Thanks in advance. It could apply to a disregarded entity because it says US 5 million of US gross receipts reported on a tax return. So likely wouldn't be that, or a information return. So the question is the company disclosed on any information return that it's filing? You'd have to look at the specific filing procedures to see whether it could fall within that exemption. It could, but it could not be. It's a good question.
It's 1:30, so we're at our end, but I have one last question, Christina, that's in the chat here. How do you see it playing out practically? Which advisor would you expect to take the lead on helping clients report? Attorney, wealth advisor, CPA, or does it just depend?
My gut is that I thought that the CSCs or CT corporations, the companies that are involved in setting up corporations would help. But right now, this is hot potato. An accounting group has come out and said that CPAs are not doing it generally. I know a lot of law firms are saying we don't really want to be in this space either. So we will see. I mean, someone's going to have to help these clients. So there's opportunity there for those who are interested in it, but we'll see, because there's no group that's stepping up yet to say, I want to do it.
No one wants to do more reporting?
No, shocking, I know.
All right, that's all the time we have for today. Christina, I am so appreciative of your time for putting this together, for presenting to us. Everybody received contact information for Christina today, along with the slides and her bio. If you have more questions, I'm sure you can reach out to her directly at the Loeb & Loeb office in Chicago. Our next event is on Wednesday, October 18th at 12 o'clock. It's Tax Consequences and Planning for Migration in and Out of California with Robert Keyes at Ernst & Young. And for those of you that are celebrating the Jewish New Year this weekend, I want to wish you a very happy, healthy, and joyous holiday. And Christina, thank you again for being here. Thank you all for being here. If we can help you or your clients as we go into the end of the year with their philanthropic goals, whether it's giving away money or setting up funds, we are here to help you. Dan, Nutella, and myself are here. Please be in touch with us, and I look forward to seeing you next month. And Christina, thank you again.